Perfect. All right, here we go. Welcome everyone. We're trying out a new time today. Typically we've done these in the evening, and this is our first afternoon. And I know that some parts of the country are have school already over, and we're in the summer months. For other parts, that's not for a few more weeks. And so we'll see how the next few weeks go. From a timeline standpoint, I also know that a lot of us like to just catch the recording. So of course, the recording will be available in our Facebook group and all previous recordings. And we do have a directory with a direct link so you can go back and easily find this recording. Let's kick this off here. For those of you who are new, my name is Tanner Withers. I am the host of this bi-weekly special needs planning workshop series. I am also the founder of All Ability Planning, which is the sponsor of this. And first and foremost, before any of that, I'm a parent of a child with special needs. And that's my little girl who's pictured here. Her name is Halsey, and we adopted her from Colombia last year, and she has a rare syndrome called Cornelia de Lange syndrome. We're just totally thrilled to have her home with us, and she's learning so much, but we're just thrilled to be a part of the special needs community after having worked with so many of you for so long. Our format looks like this. We like to do bi-weekly series on financial benefits, estate, and family support topics as they relate to special needs planning. Unfortunately, there is just not a playbook out there right now that says, hey, once you have a child with special needs, you need to do A, B, C, D, E, F, G. So we're working to do our part in creating something that parents can follow along and at least have an idea of some of the things that they may consider as it relates to the care of their child or loved one with special needs or disability. Here's the purpose of this workshop that we do bi-weekly. We want to empower families of all abilities to live their life's potential. And that can come through this planning process. The idea here, for any of you who have read or heard the poem Welcome to Holland, the whole premise of that poem is to help parents kind of get a glimpse of what it's like to have a child with special needs or what that mindset shift looks like. And the idea is if we can create a plan surrounding not only your child's future, but your life now, it makes it so that that stay in the proverbial Holland is a much more pleasant experience. The goal of these workshops is to give you the information you need to take the next step in your planning process. And we want to encourage and invite you to take steps towards bettering your situation. The format looks like this. We just moved this from weekly to bi-weekly, and we're going to test this out over the summer, as we know that summer months are typically busier. So we will do this on the second and fourth Tuesdays at 1 p.m. Mountain Standard Time. Mountain Standard Time is Utah time, which is where I'm located. These will be quick, bite-sized information. We'll do about 15 to 20 minutes worth of content, and then we'll open it up for Q&A for those of us who are live in the workshop. And then again, these will always be published and recorded in our Facebook group. This is the important disclosure, as always, before we kick it off. This is educational purposes only. Yes, I am a professional. I do give advice. Robert is a professional. He does give advice. But tonight, we're not giving it, or not tonight, this afternoon, we're not giving advice. We are strictly educating. And if you have questions or would like advice, please feel free to reach out to either one of us. If we can't be of help to you, we will certainly connect you with someone who can. All right, so here's the topic for this afternoon. Permanent life insurance, specifically for families with special needs. Obviously, this is a series, everything we do is about special needs, but the reason I wanted to emphasize this is life insurance is just different for families with special needs. For a lot of families, you may be able to get by on following the traditional, maybe Dave Ramsey style of buy cheap term insurance and invest the rest. That may work for the majority of families out there, but for our families who have loved ones with special needs, that may not be the best solution. And so specifically, we brought back our good friend Robert Dillard, who is a life insurance expert and a parent of a child with special needs, autism, I believe. Last time he educated us about sort of the general overview of insurance in general for families with special needs. And we know that permanent insurance is a key part, but it's a very confusing part. And so we've invited Robert back to talk specifically about permanent life insurance for families with special needs. So, by quick way of introduction, this is Robert. This is his contact info. We are going to flash this at the end as well. But I'm going to kick it over to you, Robert. Let me unshare my screen. Okay. Is that working, Robert? Can you hear me?
Yep, that works perfect. Can you hear me okay?
I can hear you. I'll kick it over to you.
All right, great. Let me get my screen share. Okay. Well, welcome everyone and glad you're here. It's always a pleasure to be here. Thanks, Tanner, for doing what you're doing and for being a resource in the community. There's a few now and we can always use more. I'm absolutely glad you're here. So like you mentioned before, this is just educational. We're going to go through a little bit more thoughtful exercises on some of the different aspects of permanent life insurance. And when you say permanent life insurance, there are some confusions on what permanent life insurance is because there's so many different names for different structures of permanent life insurance. So we're going to go through a couple of those today and just kind of my goal for today is just to let someone know that when you're looking at it now for a permanent need, right? So, like sometimes in our families, our loved ones are going to precede us in death, and sometimes we're going to precede them. But in a permanent type of a situation for this specific need, is we're thinking about what happens once we're gone and our loved ones need to have some extra financial support, usually funding into some type of a trust. Usually it's a third party special needs trust or supplemental needs trust. Um, so that said, there's different vehicles to fund those inside of life insurance itself. And so I kind of want to just kind of go over what I did is I put together a little bit of illustrations based on just a 45-year-old, just a standard type of a person, a male. And I put together with a company that offers a lot of different options so you can see all of the options. What I don't want to do is I don't want to necessarily speak to an individual company today just because I don't I don't like to do that. I think that there's a lot of companies that are available and based on someone's health class and how that company rates them makes a lot of difference. Also, I try to work with A rated companies are better. And also, there's a thing called a TSR score. And I like to check that TSR score, make sure that company is going to be financially solvent, meaning that they're going to be here when you need them to pay. There's a lot of just information that we do in the beginning. So first of all, I'm going to go through some of the general idea of what this is. There's whole life insurance, there is guaranteed universal life insurance. There is indexed universal life insurance, that's just a little bit different. It's on a universal life chassis, but instead of just having a guaranteed interest rate applied to the policy, it's now just got a guaranteed rate. Okay, so indexed universal life works in an indice. So it mirrors kind of some of the performance of a specific indice, like typically like the S&P 500. And it does not participate directly in that indice. Okay, it has basically a starting point and it balances on that. So if you buy it and it invests into like it mirrors at that moment at that segment, that starting point and the ending point have caps and floors or participation rates or spreads. Okay, so there's a little bit of different crediting ratings there. But for what we're talking about for the special needs planning specifically, kind of those crediting ratings and how those work is a little bit irrelevant because what our goal is to make sure that that coverage is there for our loved one when they need it. Okay. Inside of that, also, the next one is a variable universal life that also works on the universal life chassis. Okay, so the vehicle is that universal life chassis. None of these are really bad at all. They are just vehicles, financial tools to use to accomplish our tasks. Okay, so I kind of want to show you a little bit of thought process as to why you might pick one or why you might not pick one. But I will say this, in every situation, the most important thing that you'll see, there's going to be a recurring theme, is that the products that you do pick, that they offer a guarantee. Okay. So again, I don't like to show the company names. Sometimes you might see it. It's not intentional. But so this one, the first one here, this is again the standard male 45. Also, if I'm speaking outside of something and I kind of just lose you, try to keep track. You can interrupt me now or later, but I believe there is, Tanner usually has a spot for questions and answers afterwards. So you feel free to write them down or send them in the chat. I can't see the chat, and reading is not my strong suit, so I probably won't read it anyway. But if there is questions, please let them mark them down so you can circle back to them.
We got you, Robert.
Thanks. So the first illustration that we're kind of going to run through, and we're not even going to go into the actual illustration itself. This is just on like an illustrated quote. Okay. So this is a variable universal life policy. So that is the variable policy. Variable just means that it's sanctioned by the Securities and Exchange, right? So it is a variable product. It does participate directly in the market. So as I was mentioning, the indexed, that does not participate directly in the market. That has a participation based on the indice that you're selected. In a variable, you do get to choose market participating sub accounts, really, right? Or fixed accounts. So you get to have some flexibility in that with your advisor. It's not something that I do. But what we wanted to say is that some of these programs, some of these variable universal lives, they offer this no lapse guarantee. The no lapse guarantee, why it's important is because it tells you what needs to happen in order to keep this policy alive for as long as you are, right? It's a permanent policy. We want it to be permanent. So this will say that if you pay this amount of premium every year, and you want to know the rules of the company that you're going with, right? That's where someone can help you with that. Is you want to know, like, is there a time frame that needs the premiums need to be paid in? If I miss that time frame, if there's a lapse in that policy, what does that look like to regain my no lapse status, right? So before you kind of go into all of I kind of jumped on that a little bit. Before you go into actual policies, there's a few questions that we want to address, and we want to address them specifically. So one of them is really how long am I comfortable with paying a premium? And one of the ways to figure that out is you figure out basically you can figure out with your advisor like Tanner or others, right? So you figure out what that looks like on the impact of your overall retirement or your overall portfolio, right? And then you can also do what I like to do is there's a longevity calculator. So you can put that in there. You can put in some general information. It's pretty basic, but it kind of gives you an estimate of how long you're likely to live. Not specific to you. We don't have crystal balls. No one has those. If we did, we may be doing something different right now, like a beach somewhere with, some shades. Anyway, so if you want to address kind of your payment structure, how long you're going to pay. The other question is you're going to want to ask is what happens if I don't pay that? Am I okay with the outcome? So if you stop paying in one of these programs, basically what will happen is you have a little bit of cash value, and that cash value will carry your policy as long as it can until the point where it's no longer able to sustain itself, and then it will lapse. Okay. If that happens, you no longer have coverage. Essentially, you've overpaid for some term insurance. It's not a good idea. It's not in your best interest. Okay. So this is how you this is for me, like where I listen to you in a conversation of how comfortable you are in your payment structure. And if you feel like there's a time where you don't want to pay forever, and that you may say, like, I want to shift where I'm paying it from, or you just want to stop completely, those are things that we would structure it to do. Okay. And inside of a universal life chassis, you can do a limited pay. So basically, you just pay your guideline of what that looks like, whatever the company tells you for that set amount of time. So, like 20 years, example, right? Um, and also, so the converse to that is if you have the if you're not sure if there's ever going to be a time in your life that you might not want to pay, then that's where like a whole life company looks like really well for you. Like it really helps you amplify your benefits just because they have what's called non-forfeiture options. Basically, and to keep it simple, is that you're able to do what's called a reduce paid up. And that's basically taking all of your cash value and that's just letting you buy as much insurance as you can based on what you have in your policy or what's available. You'll still retain some cash value. You'll have a lower death benefit, but that death benefit will continue to grow again, and so will your internal cash values. Going to go into that a little bit longer, but basically that those two, those parameters of questions are really what sets the tone for what you want to accomplish. Okay. The reason, a lot of the reason was I bring these up is there's not a huge variation in what you would contribute or what you would pay in premiums to your policies each year based on the different vehicles because we're still, our goal is this goal right here, is just the no lapse goal. So it doesn't change a whole lot based on what we're trying to accomplish. One component to them is that the ability to earn cash value. So in general, the variable policies they offer you the opportunity for the highest earned cash value just because they participate directly in that market, like we mentioned, right? It doesn't necessarily mean that's going to happen, but these are market performing policy types. Okay, so they can offer you a higher opportunity to earn cash value. If you go into something like this, which is an IUL, an IUL will offer you a guarantee. If you see this little tab, so these are some tabs that you want to look at. If you're speaking with professionals in this realm of insurance, of life insurance, and specifically for special needs planning, a lot of companies, when you see this illustration that's provided, one thing that you can look at is look and read at what the no lapse looks like. So this little alligator that we learned about in elementary school, as long as this little guy right here is showing, this little alligator still in the water, your policy will stay in force as long as you do, as long as you obtain, as long as you continue to meet your portion of the deal, right? So insurance contracts are contracts and they're arrangements between yourself and the insurance company. I do want to say that the guarantees and all insurance products are based on the claims paying ability of that insurance company. Okay. That's why it's important to work with high rated companies. Also, like I mentioned in the beginning, the TSR report, right? To make sure that they're going to be here when we need them to be here. Stuff that we want to be aware of when we're looking for companies, because it is based on the claims paying ability of the insurance company. So this example is an IUL, and that's the indexed universal life. And this for the same individual, the required premium annually is that $16,454. And what they do is they take the calculation, they use a mortality table, and they use the cost of insurance and a few other right administrative costs. But what they do is they just basically figure out what's the minimum amount we need to charge this individual in order to guarantee that their benefits will last for as long as they need them to last. Be aware that though they have cash value, they have surrender charges, they have surrender values. In our planning, it's not always wise to use them, just because what happens is if you start using the cash values inside of these products, you start risking, if something were to happen outside, that now you're going to have a reduced, either you're going to have a reduced death benefit or you may lose even your ability to have a no lapse guarantee after the bare minimum in the contract. Okay. So sometimes the companies will pay you a minimum guarantee rate. Like they'll say a minimum, I'll guarantee this contract for a minimum of 5 years. After 5 years, we're running on a different assumption that the agent, the professional needed to add to the contract to make that be enforced. Otherwise, you're playing a flexible game inside of a universal contract. Means that you can pay a different premium and you can not pay the premium. There's things that you are allowed to do inside of universal life contracts, especially index universal life contracts and also variable universal life contracts that allow you to miss premiums and not necessarily lapse your policy. But what could happen is that you would remove then the function of the no lapse guarantee, right? You could lose that option, right? So you would have to then do some retroactive activities with your agent, with your professional, calling the companies, finding out if there's ways for you to restore your coverage to the original point where it was. Otherwise, you've changed the contract, and so the company is allowed to then change the contract based on what's in the illustration of the company. Okay, so just knowing the company, knowing the difference, and really, again, for the consumer, these are the things that you really want to pay attention to. Is the no lapse guarantee option. This, and so this is another contract, same company, right? This is just the universal life. If you notice, the premium in this universal life is exactly the same as a no lapse premium that's required in the indexed universal life. That's not by chance. That is actually what happens for them to be able to guarantee that this policy will stay in force. Okay. So in this, what we've seen in the universal policy and also the IUL policy is that essentially your purpose for maintaining coverage, it's going to cost you the same amount of money. So does it really make sense for you to have a difference as far as universal or index universal? And the answer to that is it depends on if there's ever an opportunity in your life that you feel like you might want access to cash value. Right. So if that is the case, then right. So like we just make that and we just look at like what are the estimates of the cash value that's available. Okay.
Robert, can I ask a
Yeah,
question here, a clarifying
of
question?
course. Yes.
So, with what you just said, would you say then that one of the distinguishers between considering an indexed universal life and IUL versus just regular universal life, UL, would be wanting access to cash value or not? Is
Yeah.
that one of the biggest distinguishers?
Yeah, that is a large part of it. And the other part is just kind of falling back to um, are you willing so what risk are you willing to assume as a consumer, right? And as the person with the coverage. If you're if you're wanting to have the option to access a higher opportunity for cash value, are you willing to trade off some of the guarantees that you've put into place? Right. So like if something were to happen, so like if you were to take a loan against your policy, which is against your policy, you're not actually taking money out of your policy. The insurance company is holding that. You're borrowing from the insurance company. Insurance company is leveraging, similar to like a mortgage. When you have mortgage, you earn equity and you can borrow against that equity. It's similar to that, right? It's not exactly like that, but you're not taking out your own money. You're not paying back your own money. That's not that's not true. If people tell you that, they don't really necessarily understand how that works. Um, anyway, so did that answer your question, Tanner?
Yeah, so the indexed universal life would be the higher risk but greater access to potential cash value, whereas a regular universal life would be more guarantees, therefore less risky, but also not going to have a good chance of having cash value. Is that correct?
I will say they both offer in this. So in this specific thing, they both offer the same guarantees, right? So that was our goal. So we set the parameter to offer that same guarantee. But
Okay.
what happens is the cash value component in that is going to be very different, right? So the universal life chassis is built to just make sure, like the guaranteed universal life is just to make sure that you have that death benefit. If you when you're adding on the index component, it allows it more opportunity to grow cash value if you were to ever need it, right? So
Okay.
these these contracts will still grow cash value, right? Some of them allow you to have access to them. Some of them allow you to have access at specific points in the contract, so like 25 years or 20 years, where if you needed to bail out for some reason, you needed to withdraw your policy, you could cash out that value.
Gotcha. Okay, that's great. Thank you. I've
Okay,
got a bunch of other questions, but I'm going to save them at the end so I don't derail you.
cool. All right. So, with the interest of time, so that's basically the idea there. There are differences in companies based on what you're trying to accomplish, also, right? So, so an example of this is one company, this is one company's UL policy. Um, this is another company's UL policy right here, right? So you have a difference in cost, but you still have the same guarantee. And this, I like this company just because like this company's illustration for quotes, just because it shows some different options within just the guaranteed UL and the IULs, so you can see how they function. But if you notice here, these show you that they have lapsed in a specific amount of time if you're only paying this premium right here. Okay. So that's how the difference in here works, is the difference in premiums will show you in these policies what you need to pay. But if you fall back, you'll know that the idea is that you need to pay the guaranteed minimum to get what you need to get. Um, the other thing is that I want to touch on it before it's too late is if you do, so kind of falls back into why someone might consider, say, the a whole life contract. And there are different ways to structure these, right? So this is all what's called base premium. In all of these contracts, there's not any variation. It's just all insurance. Okay. So these offer the highest cost of insurance back to the individual in all of these contracts. That's not different between universal life or whole life. That's all the same. Okay. But what it did is, so say you have coverage, your intention is to plan to pay that forever, but you're like, I don't know, what if, right? So your mindset as a consumer is you're more in the conservative side, and you say, I don't know, like I plan to pay this forever, but what happens if I don't pay this, right? So in the other policies, we know that there's some surrender value. But what happens is if you don't pay those in those policies, you don't continue your coverage. Like I mentioned, you stop paying unless you structure them that way. If you stop paying your coverage will eat up all your cash value and then stop. It will cease to exist. In a universal life in a whole life company with that is actually, you want to have one that's participating whole life company, right? Participating means that they pay you the dividends in as a company, they earn dividends based on profit share and all of this stuff, right? It's not a really important. Dividends are never guaranteed, but if you're working with strong companies, there is a high likelihood that they will continue to pay. Most of the four big mutual companies do and have shown to continuously pay those, but it is not guaranteed. What is guaranteed is this option has what's called a non-forfeiture. Meaning, so say you get into 20 years and you're, for some reason, something in your life changes, and this plan doesn't necessarily meet your planning goals anymore, and you cannot, and you don't want to continue to fund it, right? You've been paying your premium for all of this time for 20 years. And in that 20th year, you say, Tanner, I don't, or Tanner says, hey, man, we got to make some changes. Your life is happening, and life happens to all of us, just so you know. It's not a bad thing. But if life happens and you need to make a change in a whole life contract, you do have the what's called reduced paid up feature, meaning you can drop this death benefit momentarily, right? So you're going to give up some of this larger death benefit in exchange for one that's completely paid for, right? Meaning that you never have to pay another dime to this policy, and you still maintain coverage, and you also maintain cash value, which is really, again, not really our focal point, but you maintain your coverage of death benefit. What happens with the mutual company that participates and that pays dividends is that your cash value and your death benefit will continue to increase year after year, whether you're not paying any more premium, remember? So if that happens, this is like a fail safe. So again, this is set to be for people that have a more conservative risk factor, right? So like if you're like, I like it, but I'm not sure. I'm willing to pay a little bit more upfront for longer time, right? So like in converse, the other one was 16,000, this one is 23,000. Makes a difference accumulatively, if that means something to you, right? But the goal is that we're going to continue to pay this in perpetuity. It's going to continue to grow. The other thing with that is that our death benefit continues to grow along with it. So you'll hear people say that if I have a permanent policy, I lose all my cash value, and I've just been wasting that. It just goes. I don't get my cash value and my death benefit, which is somewhat true and somewhat not true, because what's happening now is that your dividends are buying paid up additions, which is just basically little miniature policies. It's just paying for them in one lump sum, and they're adding to your policy's death benefit along the way. Okay, so you're adding coverage just naturally. You don't have to do anything different. Just paying the required premium, your policy is building and actually also adding death benefit along the way, which is kind of a neat feature if you're doing this. Something that you can do inside of a universal contract. It just raises the risk factor. And also, depending on the company, you may not be able to set the parameter for a no lapse guarantee, is kind of what we were talking about before, is having that guaranteed death benefit.
So, Robert, can
Um,
I ask a clarifying question on that as well?
Please, and yeah, I'm about to stop. So what I wanted to say is that yeah, so go ahead and ask your
No, no, no.
question.
Go ahead and finish up. I don't want to derail you. I'll save that question for the end too.
Yeah, perfect. So the other thing that I was gonna just mention to that is you can actually structure uh any of these to pay for a specific parameter of time. Okay. So you have like a mutual company, you can say, I want to pay the premium. I don't want to pay the premium after I'm 65 years old, or I don't want to pay the premium after 20 years. And you can structure that policy to do those things. That's in the universal chassis, also in the whole life chassis. Okay. Um, and then you can do survivor policies, which makes a huge difference on the amount of premium that you pay, because they are now evaluating the risk factor for two people instead of one. All right, Tanner, go ahead.
I think you just answered the question. I was going to ask if that paid up or the ability to stop paying the insurance was unique to just a whole life policy, but it sounds like that is something you can build into whole life, universal life, index universal life, variable universal life, all of them, correct?
The paid up feature is not really something that you do in, I mean, you can reduce the death benefit in universal lives. They have flexibility to do that, but it's not really like a true paid up like this. This is saying like there's no more cost of insurance. We're done. Like this is just paid up, truly paid up. Okay. The universal life policies do have an option to structure a limited pay. So like you could pay it for a specific amount of time.
Gotcha. Okay, perfect. Thank you.
Welcome. And then I just kind of wanted to just show, like I'm done. I'm just gonna kind of show the difference between like a a universal life survivor policy and the difference in premium. I'm just basically, oh, I don't like to show the company. Anyway, basically I'm using a male and a female, both just standard people at age 45. We're getting $1 million in death benefit, and that shows the premium difference, right? So 6,803 I think it's $805. But anyway, if $6,803 as a minimum guaranteed no lapse, that is 2 lives. Okay. So you would pay those for both of your lives. But what we've done now is we effectively repositioned. This is 6,800. This is 16,450. Those are those are big differences in planning objectives. Something that you talk about with your advisor, or maybe it's just yourself. If you don't have another person to insure, that's fine, right? It doesn't disqualify you from providing that same benefit. It just changes the amount that you get to pay as a premium, right? But yeah, so that's the difference basically, is really it just comes down to when you have 2 lives, you can shrink your premium. You can also set these up to last for no lapse guarantee with the short pay. When you do that in a universal chassis, you're typically not going to have an increasing death benefit. It's going to stay level. So you're going to have like, it's going to be like a $1 million death benefit, but you want to guarantee that $1 million forever. It's not a good idea to have one that goes increasing like you do have with the mutual company. A mutual company will allow you to have one that increases. Okay. A lot of information. I'm not sure if I lost people. I can't see, but that's for what it is. That's what I wanted to share with you. Also, there's a lot of question around mixing in, um, mixing in like critical illness and long-term care into these policy designs. I have mixed feelings on them, but the stronger of the mixed is that your policy should have a specific named outcome. Okay. So this is we are naming this outcome for our loved one. This policy is intended to be there for them when we pass. Not if we pass, but when we pass. This is what it's going to do. It's going to provide that benefit. I do know that if you even the most properly structured plan, if the wheels fall off and you need to have care, um, that's a factor, right? So you would have access to this policy. There's you still have access to things without even structuring in something to them as a fail safe, and that's another reason why. So like one of these mutual companies might make sense, or a whole life company, is that you can do that reduce paid up feature if you need care, right? Instead of derailing your loved one's plan, you have an opportunity to stop making the premium payment so that you can reposition that payment into taking care of you. And with that, I'm going to be quiet. And are there any questions?
Robert, thank you. Georgette, you are our lone live Zoom participant. We've got others on the live stream, but we can't take their questions. So within the Zoom meeting, Georgette, if you have any questions, please feel free to drop them in the chat or come off mute. I don't want to steal your thunder. I have a bunch of questions that I'll go through. And so maybe I'll kick it off. And then again, Georgette, if you have questions, feel free to jump in here. Robert, I'm going to ask a really difficult thing, and we'll
Sure.
see. I know this is a hard thing to do, but I'm going to see if we can sum up everything we just talked about, because you're right, this can be complex stuff. If you had to give your best effort at giving one sentence on what is the difference between a whole life, a universal, an indexed universal, and a variable universal life policy, as quick and as short and as easy as you possibly can, what would that difference be between those four policies?
Perfect. Yes, great question. The primary difference becomes the transfer of risk, right? So, how much risk are you willing to assume as the consumer? And that's your profile of risk and also your ending goal.
And then if you had to, so I love that. Thank you. If you had to rank them, if you're able to do that, from perhaps most risky to, and maybe that's not the right term there, but the chance of lowest risk with the chance of highest risk, and therefore obviously highest return, how would you rank those?
Um, it's kind of hard. I mean, because they're different they're different fundamentally. Um, so like within the universal chassis, you can kind of look at them as the variable side, um, right? So if you're structuring them for what you want it to do, the no lapse, you have they allow you to have a lower premium, right? So as a general setting for one company, just in general, you would have a lower premium with that guarantee as long as you make that guarantee, right? Um, the challenge comes in is that there's a lot less variable for deviation and as a consumer. So if you start doing something like if you pay late, right, that may impact your policy dramatically different than it may impact your policy on a just guaranteed universal life chassis. So if you have like a guaranteed universal life chassis, then your premium may have some additional options there that would allow it to act the same way, right? So variables come with a lot more risk, just inherently as a subset. But again, for what our goals are, is there's not huge variation in that. Where the biggest risk factor comes in for each individual is the option to do a reduced paid up. So like if you think there's ever going to be an opportunity for you to stop paying the premium, um, unexpectedly, right? So unexpected, you say, I have some family history of long-term care needs. It's really unexpected. There's a couple of factors that we evaluate, but that's the difference between it, right? So a reduced paid up or just having to surrender a policy. So a universal chassis comes with like basically a surrender of the policy or really dropping down the death benefits and doing some figures that change the policy dynamic a lot.
Awesome. Okay, thank you for that.
Wasn't really the clearest answer, but
No, I figured it wouldn't be because this stuff is complex, and that's why it is important that we, you know, talk through it with a professional like yourself. So, um, Robert, I also want to ask you to repeat something you said in our last workshop on insurance. And I think this is important, and I want to make sure we touch on this today. I think all of these products at some time or another on social media or in other conversations have had a bad reputation, whether it's IULs, whether it's whole life or any of the others. At one point last time, you said something to the effect of there are no bad insurance products, just da 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 da. And I'm going to ruin it. So I'm going to give you the thunder there if you can finish that for us.
yeah, just bad implementation of the product, right? So bad use of the product. And so it really goes back down to understanding your risk profile and what you're trying to accomplish. And that indicates your use of that financial tool. There's no bad financial tool. The best tool is the one that's there when you need it. And how do we do that? By understanding our risk profile and understanding and placing the right product with the right risk.
Perfect. See, I wasn't even going to try it because I knew that you would just say it so much better than I would. So, um, thank you. Thank you, Robert. I want to end on this. As you were talking about this, and you even touched on it at the beginning, how do you even know how much insurance to get, right? This you kind of gave us an example of $1 million, and I think that's probably a baseline for most of us in our minds to say, sure, if I had $1 million, that'd be great. But how do you know? How on earth do you know how much insurance you need? And so I want to give you sort of a peek behind the curtains on how I approach this from a planning perspective. The first way that I approach this is by looking at the parent or caregiver's financial obligations were they to pass away prematurely, right? And so, in a nutshell, what is life insurance? Life insurance is meant to replace your biggest asset. Your biggest asset is your income while you're working. And so, at the beginning of the workshop, I said for many people out there, you could follow the traditional Dave Ramsey advice of by term meaning that insurance will end. Okay. And why would it end? Because one day you hope to retire and therefore you have no income to replace. However, as Robert said over and over and over, the need to care for our loved one with a disability or special needs is not temporary. It doesn't end. It is permanent. It is there beyond our lifetime, thus necessitating something like one of these permanent life insurance policies. And so, how do we know how much we need? It's important that we put together a very imperfect calculation that will help us understand what are the expenses that your child is going to have when they're no longer under your care, right? When you've passed on, you've moved on to the next phase of your life, or lack of life thereof. And now we have to make sure that there are assets available to our child, putting together some sort of calculation that allows us to figure out how much that's going to cost and what income they're expected to receive, like an SSI or an SSDI or something else. And the gap between the income that they're expected to receive and the expenses that they're going to have of just living their life, that is what can be filled with one of these types of policies. And so it's a much more complex calculation than that, but that's how we figure this out. And then we go and we figure out which of these risk measures we're willing to take on versus the returns and the guarantees and the things that we want to have. So, um, anyway, just wanted to clarify that. Georgette, I do see you raise your hand here. Feel free to drop it in the chat or come off mute if you like.
Hello, Tanner. How are you doing today?
Doing wonderful, Georgette. How are you?
Yes. I just want to say thank you and Robert for doing this. Like I said, this is a big interest to me. I'm actually pretty knowledgeable myself. I am not a financial planner, nor do I sell life insurance, but I've done the research and I've come a long way to educate myself. And everything you're saying today, Mr. Robert, is accurate. As a special needs parent, the goal is permanent life insurance. And I do think term doesn't make sense because, like you said, our loved ones will need this pretty much for the rest of their lives. So I do think a type of permanent is important. But going back to what you said, Tanner, you did say that with special needs children, it is important that to try to calculate the cost. In my opinion, I feel like calculating the cost can be tricky because your child's going to change and develop over time. So, for example, there are expenses that your young child may not have to worry about now, but the older they get and they transition into adulthood, they may need more support and more money. So my approach to this is you kind of have to start looking at investing in a sense, because what you want is you want your money to make money. So if you have a trust, you want to make sure that your money is staying in line with inflation. And that is very important for special needs parents. And I get it, investing is scary, but if you have the right advisor advising you on how to do it to keep your money growing, that's how you're going to keep up with inflation and ensure your special needs child is going to be okay when something happens to you. Because for me, initially, when I first started this journey, it was super overwhelming. And I had to meet with a special needs lawyer to establish trust. I had to, go to some workshops. I had to figure out all this stuff on my own. So I guess what I'm trying to say all in all is don't forget about the investment portion. So what Dave Ramsey did, what he said is not all incorrect. I just feel like it depends on the person. I think for the special needs parent part, I think the investing part is very important. The term, I don't necessarily agree with that. Everyone has their thoughts, but I do think the investing portion will be advantageous for special needs families, especially if you can't necessarily afford a permanent policy. Maybe term is the best option and you try to invest some of that money to kind of help boost it. So there are different ways you can do it. Once again, I'm just a special needs parent that has a lot of education and knowledge on this topic. And I always turn to the professional. So I'm just glad I was able to connect with you both today. Thank you.
Thanks,
Thank you,
Georgette.
Georgette.
And
Georgette,
I agree.
yeah, I was going to say, you are exactly right, Georgette. You couldn't have said it better. And I think, number one, if you haven't, Georgette, go back and watch the recording that we did all on investing as well. And even for that matter, special needs trust, that's exactly what we talk about is, hey, look, we are going to pool all of our assets together, whether they're investments or the home or anything, right? Anything of value is going to pool together for simplicity purposes into this trust, into this special needs trust. And the deficit there, whatever that estate is not going to cover, that's where these insurance policies can come in. And so you're right, we want to have not only for purposes of just the deficit, but having a variety of, diversification, right? Having a diversification of assets available to help fund our needs is exactly right. And one other thing I wanted to say that you're exactly right on, Georgette, is this is the difference between a plan and planning, right? A plan, as you mentioned, if I set up a plan today for my daughter who's 5, great. Like I can guess what her expenses are going to be like, hopefully many, many, many decades down the road. But you're exactly right. Those are going to change. They just are because she's so young and there's so much ahead that we don't know yet. And so the difference between a plan and planning is a plan just sets up the base of today. Planning helps us figure out the future and tomorrow, and we adapt and we change and we make, all of those modifications that are needed. So
Yeah, agreed. And also, if you go back and look at the 101 of life insurance, we do absolutely address kind of some of what you mentioned, Georgia, and the term. Because if you can't afford permanent now, it might not make sense for you. But what will make sense for you is having the ability to turn it into a permanent.
yep. And as always, finance is personal. And that's my favorite thing is there is no catch-all advice out there. It has to be personalized to all of our situations that are inevitably going to change. So Robert, thank you. Thank you so much again for being willing to take your afternoon and come on and educate us on the different kinds of insurance. And there are a lot of nuances and complexities. And I think you did an excellent job of breaking that down for us. If you have additional questions, in fact, I'm going to throw this back up just so we have it one last time before we wrap up here. If you have any additional questions on anything to do with insurance, any of the topics we've talked about tonight, please feel free to reach out to Robert directly. He's incredible. He is so willing and gracious to answer any questions that any of you might have. And then anything on the planning end as well, if you have any questions. Whoops, we're going to go back to this. I don't know where it is. It's somewhere on here. If you have any additional planning questions, please feel free to reach out to myself as well. Obviously, in the Facebook group is where a lot of us are. But outside of that, this is my contact information as well. Any and all of you are welcome to reach out as well. And we can get you connected with Robert as well if you don't have that. So with that, we'll wrap it up for another series of special needs planning workshop. And again, Robert, thank you so much for joining us. We will see you here in a couple of weeks.
Thank you. Thanks for being here. And I just wanted to throw out before you end it, Tanner, that if you find value in the community and or what Tanner is doing, invite someone else that you know, right? Because the more the merrier in our community, and the more people like Georgette mentioned, it's an endless hole of nothing until you find people that it can help, because it can be very overwhelming, and there's not a lot of people that do it.
Thank you, Robert. That was the perfect plug. Perfect. All right, everyone. Have a very good afternoon. We'll see you next time. Thank you.
Thanks.
Thank you. Have a good day. Bye-bye.
Bye-bye.
Bye.